And welcome to another edition of Taking Stock for the week ending the 11th of April 2025. I'm Kien, Head of Research at Stock Doctor, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Great to have you on board again, Jason. How are you feeling today?
Very, very good, Ken. The Easter eggs have already been broken up at home, and it's not even really Easter yet. So we're definitely filled with a lot of sugary energy right now.
Sounds like you're having a ball there, Jace. The Easter Bunny hasn't come to our household yet, but we'll be on holidays over the next couple of days as well. So that'll be interesting and, a good break from the volatile markets. But before we get started, just a quick yet important reminder that the information we provide today is of a generic nature and shouldn't be taken as personal advice. Remember, shares are volatile, so any past performance figures shouldn't be relied upon as a guide for future performance. Well, what a week it's been, Jace. Global markets were gripped by extreme volatility this week, based on trade war escalation, surging bond yields, and this erratic policy shift from US President Donald Trump. And that sent shockwaves through equities and bonds. And the turmoil began when Trump announced sweeping reciprocal tariffs, including 125% tariff on Chinese goods, and that triggered fears of a global recession. Now, China swiftly retaliated with 84% tariffs on US imports, Jay. So it's a bit of a trade war going on, and surprisingly, there was a midweek reversal which saw Trump pause tariffs on over 75 nations for 90 days. And that triggered a powerful relief rally across markets, only ending the week on a down note.
Yeah, it certainly was a very powerful recovery during the end of this week when a lot of equity markets around the world soared quite substantially as well. But I mean, volatility remains elevated as always, Ken. And I think a lot of investors are probably tariffed out right now. It's just I keep hearing that word every single day. I'm probably
Mm.
having nightmares right now. I'm sure everyone's having nightmares as well. Having said that, US bond yields have also soared as well, with a 10-year rising from 3.8% to 4.5% as investors dumped treasuries. And this was previously viewed as a safe haven because there was a bit of a re-kick in terms of risk assets back into equities. I mean, the rare concurrent sell-off in both stocks and bonds, especially towards the end of the week, deepened some investors' fears about inflation and also doubts about US policy credibility, which sort of makes sense because no one really knows what is going on. Some also suspect that China may be offloading potentially its trillions in US bonds, and that could be quite detrimental to the market.
Yeah, crazy volatility, Jason. Despite the bounce, investors remain cautious, with futures now pointing to some downward pressure on the last day of the week. And the US bond market, and that's been rattled by inflation and growth fears, played a key role in forcing the tariff pause. Economists now warn that even with a pullback, the average US tariff remains at around 25%. And this continues to weigh on consumer sentiment, shareholders, and also corporate investments and to corporate earnings.
Yeah, and some of these tariff pressures have also impacted Aussie healthcare stocks at home after Trump signaled potentially new tariff on pharmaceuticals, and this is targeting any foreign-made drugs. The US is concerned, obviously, about Australia's pharmaceutical benefit scheme, which they see as a disadvantage to American pharmaceutical exporters competing with generics.
Yeah, and a key star stock that's been affected is CSL, and that tumbled 5% amid investor concerns over cost pressures and supply chain impacts. So the move did raise alarms about potential headwinds for the Australian biotechs and medtechs here that are exporting to the US, but we'll speak more about this later in the episode.
Yeah, that's right, Ken. And with markets being pulled in many different directions by trade tensions, inflation worries, and also changing policies, it's very important to focus on what you can control. And that is staying disciplined with your portfolio and also managing risk. So try to stay level-headed, avoid acting emotionally, and make sure your portfolio is well diversified, ideally across 15 quality stocks. These periods of volatility can actually be a good chance to pick up some strong companies at better prices.
Yeah, and the Australian market has fallen by about over 15% from their highs. And despite the relief rally this week, many stocks have still breached the SD30 TSR. That's the 30% stop loss from their highs. Some of these include, for instance, Pro Medicus, Netwealth, Hub24, WiseTech, and Breville Group. So you can search for a whole list of these stocks by referring to the watch list and sorting stocks by the SD30 TSR, for instance.
And remember, markets can be unpredictable, and this week was a good reminder of why timing the market often backfires. Some investors pulled back on Tuesday just as headlines were at their most negative, Kien, but that turned out to be one of the worst times to move out to cash.
Yeah, that's right. And speaking about this negativity and also oversold stocks, over the week we had investment platform operator and star growth stock Netwealth. They provided a trading update. Now, Netwealth has been on a wild ride with many investors offloading the stock, given that its earnings are tied to the share market. However, Jace, the announcement this week wasn't too bad, was it?
Yeah, the company actually grew its funds under administration by 2.4% over the March quarter, and this was even with all the market volatility that was around. The growth was supported by solid inflows and more clients were coming on board. Revenue held steady as well, which should help underpin the growth outlook and also the return on equity moving forward.
Yeah, that growth outlook still looks quite strong, Jace. It seems that there's still plenty of opportunity for Netwealth, given that it only has around 80% of market share in that space. Both father and son, Michael and Matthew Haynes, they continue to lead the company and own close to about 50% of shares. Moving now to another stock within the financial sector is Challenger Group. Now, early in the week, the stock defied the market decline and jumped by 8% on Monday. So, what drove the reaction here?
Yeah, it's pretty interesting with what's happening right here, Keen. Japanese insurer Dai-ichi Life took a 15.1% stake in Challenger. The company's paying around $8.46 per share, which is around a 53% premium above Challenger's share price at that point in time. So it's a big, big premium. And this fueled talk that the stock might be a little bit undervalued previously, which sort of sparked speculation that Daiichi was sort of eyeing a potential full-blown takeover down the track.
Yeah, a lot of speculation there, Jason. And with Challenger reaffirming their profit guidance in February and also trading on a gross dividend yield of around 6 to 7%, this is definitely a stock to keep an eye on. Okay, now let's turn our attention locally to the federal election, Jace. A stock that will be heavily influenced by the immigration policies that's been going to be released is IDP Education. Now, earnings revisions have been weighed down by lower IELTS volumes and also weaker international student placements here, especially into key markets like the UK, Canada, and Australia.
Yeah, that's right, Ken. And the immigration clampdown in some of those countries that you've just mentioned really hurt the company. Stringent student visa rules, especially in Australia and Canada, made it harder for students to get into the country and attempt to study. And that's always been IDP's bread and butter business. But we are sort of seeing some green shoots, particularly out of the UK, given that they've recently finished their elections.
Yeah, that's right, Jace. Post-election in the UK, there's more policy certainty,
Mm.
and that's also helped student volumes recover over time. And that could be a sign for things to come for IDP, given the forward elections in both Canada and Australia, which could be that turning point.
Yeah, that's exactly right, Ken. Take Canada, for example. I mean, if Mark Carney remains PM, then he's expected to take a more balanced approach to immigration based on his previous comments that he believes that immigration continues to play a role in growing Canada's economy and also closer in Australia as well. Clarity around some of the immigration and also student impact policies post the election would also help the sector to reset.
Yeah, and in Australia here, Jace, the best outcome for IDP is if the incumbent Labor government, if they win the upcoming election, given that they are slightly more accommodating to student immigration. However, despite this, irrespective of the election outcome, it's interesting to note that current student placement volumes are around 10 to 20% below Labor and the opposition caps that's been implied, and this provides a buffer to all that policy uncertainty. In Under the Microscope this week, we take a closer look at Australian pharmaceutical company CSL. Now, the stock was under pressure this week after Trump said he was going to announce tariffs on pharmaceuticals. Now, this reflects the concerns raised by US big pharma giants that they want Australia to pay more for their drugs. And despite all this uncertainty, I noticed that the earnings expectations for CSL they remain quite resilient with revisions positive over the last 3 months. So, what's been driving this disconnect, Jace?
Some of the positive earnings revisions could be due to a number of things. So, firstly, we're seeing a really strong recovery in the blood plasma product demand post-COVID, and on top of that, the company's R&D pipeline continues to deliver. So, this might drive some of the near-term earnings momentum that we're seeing right now.
Yes, Jason. I also noticed that the Australian dollar relative to US dollar has declined materially this week. And although CSL does report its revenue in US dollars, the
Mm.
business has manufacturing facilities in Australia, and a drop in the Australian dollar will reduce its cost base, such as wages, utilities, and R&D in US dollar terms. So if the Australian dollar stays low, this will lead to improved margins for the business and potentially contribute to that positive earnings revisions. But Jace, investors are concerned about the impact of these tariffs on the business. How large will this be?
Well, this is the million-dollar question, Ken, that everyone's probably asking. Look, the tariffs will probably impact the demand for imports and potentially hit margins. However, in CSL's end, the company has already flagged that they are reviewing the manufacturing footprint to sort of stay agile. The management team have also mentioned that they have manufacturing sites across the US, in Europe, and also in Australia as well, and they can sort of shift manufacturing across these areas to protect the supply chain and also mitigate some of the cost risks that you mentioned earlier.
Yeah, definitely. So much uncertainty there still, though. But this could be the reason why the stock is trading at a significant discount to their fair value. For long-term investors, this could be an opportunity, although we expect the share price to be quite volatile in the short term due to this tariff overhang, Jace.
Yeah, and also strong plasma collections have also driven some of the margin recovery that we have seen from the company, and this should support the improvement in also the company's return on equity as well. At the same time, Vifor, the segment that is focused on iron deficiency treatments, that segment is also expected to deliver relatively steady growth. So it seems like things are relatively on the mend for CSL moving forward.
Yeah, looks like it. But in the broader healthcare space, though, Jace, who's the best and worst position if tariffs do come on?
Well, starting from the worst impacted, Kien, is probably Ansell. The company produces safety equipment and also medical gloves in Asia, and about 90% of its supply chain faces US reciprocal tariffs of greater than 10%. So this is a bit of a problem in terms of the distribution end. On the other hand, companies with a more domestic exposure or well diversified facilities include ResMed, which is expected to be better insulated against any of these tariff policies.
The sharp rise in long-dated US bond yields this week was a turning point in global financial markets and a key factor in President Donald Trump's decision to partially reverse course on his sweeping tariffs. So, an interesting question this week, Jace, is what does rising long-term bond yields means for the investor?
Well, bond yields often reflect where interest rates are expected to head.
Mhm.
So, any sharp shifts in US treasuries, and this is typically seen as a safe haven, are heavily sold off. And this pushes the 10-year yield up from 3.8% to 4.5% in the short term, which is a pretty rare move. The sell-off was also driven by fears of a global trade war, and this could stoke inflation concerns and make it harder for the US Fed to potentially cut interest rates.
Yeah, definitely. Long-term US government bonds, they typically appreciate in times of crisis because investors trust their credit worthiness and anticipate that the Fed will cut interest rates sharply, boosting the value of these bonds. However, the bond rate represents the government's financing costs, which did jump materially over the week. And that indicates that there was a loss of confidence in this government debt.
So from a share market perspective, higher interest rate expectations reduce equity valuations because it reduces the present value of future earnings and cash flows as well. And it also potentially leads to higher borrowing costs that you mentioned earlier before, Kian, as well as reduced spending on the consumption end for goods and services.
So definitely the bond market is the one to watch as well here because it can create a lot of volatility in equity markets. But that's all we have time for today, Jace. Thanks for your contributions again.
Thanks for having me, Ken. It's always a pleasure. And for viewers at home, if you have any questions, please join us for Lincoln Live next week. Also, as a reminder, there will be no Taking Stock episode next Friday, given that it will be a Good Friday holiday. Having said that, we wish everyone a very happy and safe Easter break.
Yeah, and remember, with the market being so volatile, remember to embrace it. Don't let your emotions take hold. Block out the noise and focus on what you can control. And that's the management of stocks in your portfolio and also focus on risk management as well. Take care and have a happy, healthy, and prosperous week ahead.